Okay, Workshop 5 brings together a lot of the concepts that we have been talking about. We started off in the course learning about supply and demand and how the intersection of supply and demand brings us to a market price and a market quantity that's called equilibrium. And then we learned in the last workshop about cost curves, and a typical firm has cost curves that look like this. The marginal cost intersects the average variable cost and the average cost at their minimum points. And then we also learned about long-run average cost and how there are different smaller sizes of facilities that can be increased and lower our cost if we have the sales to generate the usage of the plant. And that we reach a point of no return, though, or a point of diminishing returns when we go too large in our plant and the average costs actually end up being higher than they were in this area here. This area is called the efficient scale. The minimum efficient scale determines what kind of market structure is going to be in effect for the good that is being produced. The first one we talk about is perfect competition. There is a supply and demand curve in action on something that is sold in perfect competition. The product cannot be differentiated one supplier to another. So let's take, for example, wheat. Wheat can be produced by thousands of farmers across the country. Some of them have large farms, some of them have small farms. They are all fairly efficient. A market price is determined for wheat. If you're in that business, if you're a farmer making wheat, you have to accept that price. If you try to charge more, your product looks just like everybody else's. You're not going to sell anymore. So you're going to end up being a price taker. So the demand curve for you is a horizontal or a perfectly elastic demand curve where your marginal revenue and your average revenue are all equal to your demand. The demand curve is where we find our price. So when we overlay the demand curve onto a typical cost curves for a farmer, for example, making wheat, what we'll find in the long run average, the farmers will operate where the demand intersects the minimum of the average cost curve, which means they make no economic profit. That doesn't mean a bad thing. It just means that they have an accounting profit, but the amount of money they make on what they've invested is equal to their best alternative. If they were to go into something else, their best alternative would not produce better results than where they currently are. So they stay in the farming business, making an accounting profit, knowing that that's their best alternative. There are situations that exist on an individual firm basis, though that analysis there is for the average of the business of all the farmers. But you could have a farmer that has a demand curve well above his average cost. He is super efficient, has the latest and greatest farm equipment, and is able to operate at a level that is higher than his average cost. He makes an economic profit. You could have a firm that is operating somewhere below their total cost, but above their average variable cost. In the short term, they keep operating because their maximum profit is still to keep operating when average variable cost is covered. So they stay in the business in the short term, but if they stay that way, they're going to eventually have to leave. When they reach a point where their price curve, their demand curve, is below their average variable cost, it's time to shut down. Shut down immediately and exit the business. That is what's known as the shutdown rule. All right, now let's look at another market, and that would be the monopoly. Now the monopoly, a pure monopoly in this country barely exists. The best example is probably drug manufacturers who are given patents on drugs that they invent for 25 to 30 years. The pharmaceutical companies that are lucky enough to achieve a success with a drug are given that patent, and that allows them to operate virtually as a monopoly for those 20 years. What happens then is they have a downward sloping demand curve because they can distinguish their product from someone else. If you cannot make your product look any different than anybody else's, then you're going to be in perfect competition which we just discussed up above. So where does marginal revenue equal marginal cost? Because that is where profits will be maximized. Well, here's the marginal revenue curve. We talked about this in an earlier workshop where if you have the demand curve, halfway over here will be where the marginal revenue curve intersects. So where the marginal revenue curve intersects marginal cost, which is this point right here, if we continue to draw a straight line up, we go up to the demand curve and come over. That is the price that we could charge. And our average cost is just under that in this particular example. So the monopoly operates at a profit. And it could be even bigger than what I've demonstrated here. But that is how you establish where you're going to operate if you have a pure monopoly. Okay? The next one is an oligopoly. And the one thing I'll say about an oligopoly is if you go back to the long-range average cost discussion, the minimum efficient scale for operating in this market is very, very large. You have to have a very, very large operation. And a perfect example is the automobile industry. To make an automobile, a company would need to build a factory that costs about $1 billion, filled with automation, robots, and equipment of all sorts, and lots of people lined up on a serpentine assembly line putting the car together. And they can make about a car a minute on an assembly line like that. It doesn't take them a minute to make one, but there's one that comes off the line every minute as it winds its way through the factory. So it's very, very difficult for someone to get into a business like that. And what happens is, for these firms that are in that business, market share becomes their #1 priority. So they are pricing it with respect to each other. They are acting interdependently. They are not allowed to consult with each other on what prices, but what everyone is charging is common knowledge. They can just check. So what happens is the way an oligopoly actually works is the demand curve in the beginning is somewhat horizontal, somewhat elastic. If you lower your price, you can gain a fairly large jump in quantity sold till you reach a point. You reach a point where the competitors of yours will not give up their market share. And now the demand curve gets very steep at that point. They will not follow you down any farther on, or they will follow you down on price decreases, but they will not follow you back up on price increases. So what keeps oligopolies operating is their ability to watch each other and to keep their costs relatively in line compared to each other, and then they protect their market share. A monopolistic competition, now that is a barber shop, a beauty shop, a restaurant, a gas station. That's where there are thousands and thousands of suppliers, but unlike perfect competition, they are making distinguishing products, okay? Now you might not think that a barber shop can distinguish itself, but it can by location if nothing else. So if you're located at a busy intersection where it's easy for people to see you and get to you, you'll have an advantage over somebody that's got a barber shop out in a rural area. So they can distinguish themselves by location and sometimes even the quality. Some restaurants provide a better quality than others. So there's a lot of things that allow them to distinguish themselves. But in the long run, and I've drawn this with the orange lines, in the long run, their average cost will be equal to their price. The demand curve will intersect the average cost curve. Notice it doesn't intersect it down here at the minimum like it does in perfect competition, because they are not really operating as efficiently as perfect competition would. So what happens is they operate up in here. Their average cost is still equals their price, and so there is no profit in the long run. And just as there was in examples in perfect competition where there are places that do better than others and places that do worse than others, the bottom line is on average, this is where you will be, where your average cost equals your price, and that means you make no economic profit, just an accounting profit, okay? So that pretty much summarizes it. I hope this helped you out a little bit along with your textbooks readings, and let me know if you have any questions. Thanks.